Hi folks, Nick here again. 2 videos in one day, maybe more. I just got a question that is perfect. It came from John. John is relatively new, so he may have not heard me say it enough. John's question is very valid. I love iron condors in this environment. I've told you so because we're meandering. We're push-pull, no commitment either way. So iron condors bring in profits from both top line and bottom line, okay? And I'm usually talking about, say, the SPY. Let's look at that. So in a boring, when you know the upside and you know the downside, you sell here, you sell here, and you try to bring in income from both ends. Credit put spreads and credit call spreads. Credit put spreads is bullish because I want price to stop above it. Credit call spreads is bearish because I want price to stop below it. Okay, so these are iron condors. They usually increase double my yield, meaning if I collect 25 cents here, I can collect another 25 cents there without increasing the money at risk because I can only lose on one side or another, okay? So that's usually attractive to me, provided I don't open, because now the chances of loss, I can lose on both ends, on the top and the bottom. So the chances of loss increases, but not the money at loss, right? Because risk, twofold, you got the dollars at risk and the chances of risk. Okay, so in this case, I was asked, what do you think about a May iron condor for Priceline? This is Priceline. You know Priceline is a momentum stock. It runs fast, this way or that way. I've seen it run $40 easy in a day often for no reason whatsoever. So the levels they suggested were 1270, 1275, meaning right now it's 1190, let's say 1200. They want to sell a spread way up here. So they want to sell the 1270 call and buy the 1275 call. For this, you're bearish. You want Priceline to, in May, go up but not past the 1270 because this is where you lose money. So to hedge that bet, they also want to sell an 1115, let's say around here, put and buy the 1110 put. For that, you collect more money. So now you want Priceline to stay in between 1115 and 1270. Sounds like a big range, right? Okay. In theory, that's an iron condor. It's $5 wide. For this risk, someone is paying $2 for the spread. So if I do this, I collect $2 right now, and mid-May, when the options expire, if Priceline is in between those two values, 1270 and 1115, I keep the $2 per contract. So if I do 10 contracts, that's $2,000. Sounds like attractive, right? Let me flip it around. Okay, so $2. The width of the spread is $5 either side, right? Maximum loss here is $5 minus the $2 I collected, minus loss down here is $5 minus the $2 I collected. So that's a good risk reward. However, if you think about it, the maximum loss is $5, and somebody's paying me almost half of that in premium. That tells me that there's a high chance I want to lose. It's a high-risk trade. It means it's almost a coin flip. They're almost paying me half of the spread because there's that much risk, half of risk. So 50%, that's a coin flip. Half is a coin flip. That's unacceptable for me as a risk, me personally. Why? Okay, let's look back at the last 2 earnings reports, just the last 2. This was the last one. The stock moved $100 from the earnings to a couple of days thereafter, and even more 3-4 days after. So it went from here to here. That is way more than $100, 150 if I'm eyeballing correctly, from 1110 to 1260. What would have happened to this spread had it been open then? It would have been a complete loser. So you would have lost $3 because, yes, you collected $2, but the risk is $5. You would have been, the price would have gone through both legs, and it would have priced 100%. So now you have to give back 5, but you collected 2, so you lost 1. I'm sorry, yeah, you have to give back 5, but you collected 2, so you lost 3. So in essence, yes, you had a chance of collecting $2,000 because you did 10 contracts, but you ended up losing $3,000. So would have blown out. But you say, oh, this was a fluke. Okay, let's go back 1 earnings before that. stock dropped $100. 12.30 before the earnings, 10.80, more than $100. So it is, I'm sorry, yeah, thereabouts. So this one would have also blown it out on the lower end. So any which way you slice it, whenever you collect about half the premium on a trade, means you got a coin flip chance of losing. To me, that's not investing. To me, that's a risk that is not attractive to me for my personal taste. Some people like it. If you're comfortable flipping coins for money, you can do this trade. Otherwise, it's too much risk, in my opinion, for not much thesis behind it. When I put money on the line, I want a thesis behind it. I want fundamentals. I want technicals to support it, meaning I want support and resistance levels to be in play. On earnings, all that is out the window. You don't know what the markets are going to do. I bet you the numbers deliveries here and the numbers delivery here were about the same. It's how the markets perceived it. Let's go back another one. Big candle and a huge drop thereafter. So you don't know if it's related or not. The one before it, a big candle down. So here we go. Down, up, 50%. The reaction to the numbers are 50%. 50-50 chance you're going to be right or wrong, period. So there's no distance wide enough that's, quote, safe. And when I'm collecting $2, I better be expecting a coin flip outcome on this bad boy. Those are momentum stocks. And you say it's a fluke. Okay, well, let's look at Netflix. But you can find the same thing. Look at this earnings. Can you tell me any iron condor surviving this? How about this one? Any iron condor surviving that? No. How about this one? Any iron condor surviving that? No. Okay, so Amazon. They trade the same way, all of these guys. Any iron condor surviving this? No. How about this one? This one, it could have survived something, but severely challenged. This one, no survivors. This one, no survivors. So these are trades that pay well because they come with incredible risk. For me, it's not my thing. This is just to show you, I answered a question in form of a lesson. So hopefully that it helps you just start to think along the lines of, okay, I'm collecting this much. Why? Why is someone paying me $2 on a $3, on a $5 wide spread? That's because there's almost a 50%, 40% chance I'm going to lose. All right, Nick signing out. If you have any follow-up questions, please let me know.